Picture this, it's the 17th century, and the world is about to witness the birth of the first stock market. The bustling city of Amsterdam, known for its trade and commerce, introduces a revolutionary concept, the Amsterdam Stock Exchange. Here, investors could buy and sell shares of companies, essentially owning a small piece of these enterprises. This was a game changer. It was the first time that capital, a crucial component for any venture, could be raised from the public rather than relying solely on wealthy individuals or monarchs. The stock market provided a platform for businesses to grow, innovate, and explore new opportunities. It was the dawn of a new era, setting the stage for modern capitalism as we know it today. This wasn't just about economic growth though, it was also about democratizing wealth creation, allowing everyday individuals to participate in the financial success of businesses. And thus, the concept of trading stocks was born, a concept that would forever change the world of finance. Fast forward to the 20th century, the stock market had its share of highs and lows. Two of the most significant downturns that shook the financial world were the Great Depression of 1929 and the dot-com bubble in 2000. The Great Depression, a worldwide economic disaster, began with the infamous Black Tuesday on October 29, 1929. This was when Wall Street experienced a catastrophic crash, causing a decade-long economic downturn. The cause? Overspeculation and excessive optimism had inflated stock prices beyond their real value. When the bubble burst, it resulted in a massive sell-off. The impact was devastating, causing widespread unemployment and poverty. Then came the dot-com bubble at the turn of the millennium. This time, the optimism was around the potential of the internet. Startups with no profits or even revenues were going public and their stocks were skyrocketing. The promise of the World Wide Web had again led to overspeculation. When the bubble popped, many of these companies, referred to as dot-coms, went under, causing a severe loss to investors. In both cases, the crashes followed a similar pattern. There was a new technology or idea that led to rampant speculation. The stock prices were driven up, creating a bubble. When the reality did not match the hype, the bubble burst, leading to a crash. These crashes had far-reaching economic and social impacts. Millions of people lost their jobs and their life savings. Companies went bankrupt. The repercussions were felt not just in the United States but around the world. These historical events serve as stark reminders of the volatility and unpredictability of the stock market. They emphasize the importance of not getting carried away by the latest trends and hype. They teach us to be cautious and to always remember that the value of a stock should be based on the underlying company's actual performance and not on speculative future prospects. Above all, these events underline the need for diversification and risk management in investing, lessons that we will explore in our next segment. But for now, let's remember, the stock market has the power to create wealth, but it can also lead to substantial losses if not navigated with care. From the ashes of these crashes, important lessons were learned. One of these lessons, perhaps the most crucial, is the importance of diversification. Diversification, in essence, is not putting all your eggs in one basket. It's spreading your investments across a variety of assets, such as stocks, bonds, real estate, and commodities. This strategy can help mitigate risk and increase the potential for returns. Think of it as a safety net, catching you when one or more of your investments falter. Let's take a trip back to the dot-com bubble in the late 90s. Investors who had diversified portfolios were able to weather the storm more effectively than those who had invested heavily in tech stocks alone. This is because when the tech sector crashed, the other sectors in their portfolio remained relatively stable, providing a buffer against the losses. This brings us to our second lesson: risk management. Risk is inherent in investing. It's a game of probabilities, not certainties. But that doesn't mean you should throw caution to the wind. Quite the opposite, in fact. Successful investors understand the importance of managing risk. One of the ways to manage risk is through asset allocation, deciding what percentage of your portfolio to dedicate to different asset classes based on your risk tolerance, investment objectives, and time horizon. Another is by staying informed and keeping a close eye on market trends and economic indicators. Let's not forget the importance of long-term investing. The stock market has historically shown a tendency to rise over the long term, despite short-term fluctuations. Investors who maintain a long-term perspective, remaining patient during market downturns, often reap significant rewards. Remember the Great Depression of 1929? While it was a devastating event, investors who held onto their stocks and weathered the storm saw their investments eventually recover and grow. This underlines the importance of patience and long-term perspective in investing. From these lessons, the principles of prudent investing were carved, guiding the decisions of investors worldwide. Among the crowd, few stood tall, their insights and philosophies shaping the world of finance. In the annals of stock market history, certain names echo louder than others. Warren Buffett, the Oracle of Omaha, is one such titan. With a net worth of over $80 billion, Buffett's success is a testament to his value investing approach. Heavily influenced by Benjamin Graham, Buffett's strategy focuses on buying stocks that are undervalued, an approach that has stood the test of time. His advice to be fearful when others are greedy, and greedy when others are fearful, encapsulates his contrarian approach to investing. Speaking of Benjamin Graham, often heralded as the father of value investing, his impact on the stock market is undeniable. His book, The Intelligent Investor, serves as a Bible for many in the world of finance. Graham championed the concept of margin of safety, urging investors to buy stocks at a price well below their intrinsic value to cushion against potential losses. His philosophy of buying undervalued stocks and holding them for the long term has influenced generations of investors. And then, there's Peter Lynch, the man who made the phrase, "invest in what you know," famous. Lynch, who managed the Fidelity Magellan Fund, achieved an average return of 29% during his 13-year tenure. His simple yet powerful investing philosophy encourages individuals to invest in companies they understand, bringing a sense of simplicity to the often complex world of investing. These giants of the stock market have not only amassed great fortunes but have also shaped the world of finance with their wisdom and strategies. Their philosophies, although different in approach, all emphasize the importance of patience, discipline, and long-term thinking when it comes to investing. As we navigate the ever-evolving landscape of the stock market, these timeless insights continue to guide investors. They remind us that while the market's whims can be unpredictable, a sound strategy and a cool head can yield significant rewards. Their wisdom continues to illuminate the path for investors around the globe. Today, stock markets are more than just a place for trading stocks. They've evolved into a global phenomenon, becoming the pulse of our economies and a barometer of our societal health. Stock markets today are vast, complex systems where millions of transactions occur every day. These transactions reflect the collective decisions of individuals, corporations, and governments around the globe. When we look at stock markets, we're not just seeing numbers and charts. We're witnessing the ebb and flow of human aspirations, fears, hopes, and dreams. These markets aren't just about profit and loss, they tell stories. Stories of companies that have risen from humble beginnings to become global powerhouses. Stories of industries that have transformed our lives and reshaped our world. Stories of economic cycles, of booms and busts, of innovation and disruption. Stock markets are also powerful engines of economic growth. They enable companies to raise capital, to invest, to innovate, and to create jobs. They facilitate wealth creation, allowing individuals and institutions to invest in the future and reap the rewards of economic progress. Moreover, stock markets have a profound impact on the world economy. They influence everything from interest rates and inflation to foreign exchange rates and economic policy. When stock markets sneeze, the world economy catches a cold. When they thrive, the world economy basks in their glow. But stock markets are not without their challenges. They can be volatile and unpredictable. They can be influenced by geopolitical events, technological changes, and even the weather. They can create wealth, but they can also destroy it. Yet despite these challenges, stock markets remain an indispensable part of our global economic infrastructure. They're a testament to our innate desire to innovate, to take risks, and to forge ahead even in the face of uncertainty. In the end, stock markets are a reflection of us. They're a mirror of our collective ambitions, our triumphs, and our setbacks. They're a testament to our resilience, our adaptability, and our ceaseless quest for progress. In this globalized world, stock markets have become the heartbeat of our economies. They're the pulse that keeps our global economic body alive and thriving, shaping our present and paving the way for our future. As we journeyed through the history of the stock market, we've learned some valuable lessons. From the birth of stock markets in 17th century Amsterdam to the modern global economies of today, we've seen the power of investment, the dangers of speculation, and the resilience of markets in the face of adversity. We've discovered that diversification is not just a strategy, but a survival tool. That risk management is the compass guiding us through the volatile seas of finance, and that long-term investing is a journey, not a sprint. We've met the giants of the stock market who've taught us the value of patience, wisdom, and unshakable belief in one's convictions. We've seen crashes and recoveries, booms and busts, and through it all, the enduring power of the market. And just like the stock market, we continue to evolve, learn and grow. So, keep investing, keep learning, and remember, the best investment you can make is in yourself.